Welcome to Going Long, the FCLT Global Podcast. Today, I'm joined by Ron O'Hanley, Chairman and CEO of State Street, one of the world's leading financial services firm. Over the course of his career, spanning State Street, Fidelity, BNY Mellon Asset Management, and McKinsey, Ron has helped shape some of how the largest pools of long-term capital think about markets, risk, and global change. And I've been lucky enough to work with Ron over many years, so I know he's shaped my thinking as well. So in this conversation, we'll explore State Street's idea of reglobalization and what that really means for long-term decision making. So Ron, thank you for joining me today, and thank you for being such a supporter of focusing capital on the long term and long-term thinking in general.
Well, Sarah, it's a pleasure to be here, and thanks for having me.
Great. So let's just jump in. State Street and you have argued that we're not entering an era of deglobalization, as a lot of people talk about, but one of reglobalization, where the world is reorganizing rather than retreating. And so, from your vantage point, can you tell us what does that framing mean for investors, and what does that help people understand that the more traditional or conventional narrative is missing?
Yeah, so for Sarah, for certainly almost the entirety of both of our careers, we've enjoyed this era of globalization, and it was at some level pretty straightforward that the world was globalizing. It was largely it was enabled by lots of things that we can go into if we need, but in terms of the objective, it's like let's be most efficient about everything, where we manufacture, where we source labor, where we source capital. It was really a very almost market-driven kind of approach to the world. The rules seemed pretty easy and straightforward, and many companies basically grew and shaped their strategies based on that. We've seen what some people would describe as peak globalization, and now even talk of deglobalization. But that implies deglobalization implies that there's some kind of return to the past, and I think actually we believe that that's actually not what we're seeing at all, or what we will see at all, but that the single-minded focus on efficiency of capital, labor, cost, et cetera, will not be followed any longer. That there'll be many other objectives that are injected into this, and that the idea that somehow trade is going to stop, or that international activity will stop is not the case at all. And the evidence is there. Just look at China in 2025. I mean, if we were deglobalizing, would China have reached peak exports, record exports before the year was even over? They'd actually, less than 11 months into the year, had achieved more exports than any other time ever, and I think ended the year at 1.2, 1.3 trillion in exports. And so that's an illustration of what we see, is that patterns are changing, trade patterns, capital flow patterns are changing, and what that means for the long term, I think, is now the great uncertainty, right? What will finished look like in all this? And that's what we really don't know yet.
So rather than breaking roads, if you will, or breaking ties, it's just we're doing the ties in different ways. The patterns are not the ones we're used to, and I think at least for many years, there's sort of been this feeling that the things come in and out of the United States. Think about foreign currency. You go into the dollar, you go into some other currency. But so that pattern is what you're seeing is really changing. Is that right? Yeah.
Exactly. And it's because the objective function has changed. Some of it's very straightforward, right? COVID illustrated the challenge in kind of single source supply chains. And when you've optimized your supply chains for maximum efficiency, that works as long as the supply chain works. Supply chains broke. So what do we see now? Dual source, tri-source kinds of things going on, where instead of one supplier or one supplying country, you have multiple national security interests. have become much more dominant, whether they're real or perceived. Like this is in our interest to do this, or this is not in our interest to do this. Um, and so, as a result, the predictability of the prior system is no longer there. These objectives are not necessarily wrong. They're just different objectives. And so where it all ends out is what we don't know yet.
Yeah, and how do you think decision makers, investors, or companies who are trying to make long-term decisions, they're trying to make long-term capital allocation decisions, how does this affect that decision making? Because if they've been trained their, whole life on efficiency and low cost of capital and, all of those sorts of things, how do you rewire that thinking?
Yeah, it's a really good question. So if you think about it, just take the very simple example of from one supplier to multiple suppliers. I mean, at some point, what you're doing that for is a form of insurance. Well, how much should I pay for that insurance in the case that maybe something's going to happen with supplying country A, such that I want to have a supplying country B and C? And how do I think about quantifying what that real risk is, and in making that trade-off of okay to try and burn down that risk, I'm willing to pay this in terms of inefficiency or extra cost in terms of doing that. Um, the From the investor's perspective, the uh, the if you will, the ease of evaluating something has now become harder because there's more variance around policy. Um, there is a cost to redundancy. There's a cost to optionality, and when you're evaluating a particular company and trying to understand what they're doing, you have to ask yourself, well, one, do they have, so you're now one step removed. Is there exposures that they may have that I don't really understand, or they're going about all this? What does it mean for their long-term profitability? I understand what they're doing, but what does it mean? So it's will have implications for cash flows, will have implications for cost of capital. Inflation is actually probably, it's not just a concern for the particular investment you're making, but in the aggregate, what does this mean for all of us? And when we think about, are there inflationary pressures or not in an economy, some of this reglobalization and the cost of it needs to be evaluated. And I don't think that's actually been fully incorporated as we think about what the direction of inflation is. And then finally, just, the risk premium. As I look at a particular company and I see all this high degree of efficiency because they've got these finely honed supply chains, is it as good an investment as I think it is? Because I don't believe they've actually taken some of the steps that some of these risk reduction or risk management steps that we're talking about. So it just makes the world a whole lot harder to evaluate in terms of risk, reward, and uncertainty.
Mm-hmm. Yeah, it is. And your point on inflation is a good one. Obviously, redundant efficiency is anti-inflationary and redundancy is more inflationary. So your examples have been more about goods, supply chain and so on. How do you think about the same thing in services or capital flows? Because I think we're also seeing, people have tried to do services in the most efficient way, service from the right location, et cetera. And then also capital flow. Capital flows have been more or less, with a few exceptions, more or less seamless over the last, decade or two. You could just put it in the highest source of return as an investor. There's this reglobalization pattern happening for services and capital as well, do you think?
Well, I mean, just like it has when this, if you go back 30 years when this all started, 30, 40 years as this globalization trend started, it started with goods and capital quickly followed. And in fact, capital became the dominant flow in all this. So you have to believe that there'll be some disruption in this. And how you think about things like trade finance and those kinds of things will clearly get changed as you start to see this reglobalization of trade flows. I I also think that, I mean, services is a little bit different in that in uh, it doesn't have. I mean, at some level, it's the same in that, if I, country A, am exporting a service to country B, that's going to show up in the numbers and all that. But services are also a little bit easier to actually move the source of the service from country A to country B. Uh, we both started our careers at McKinsey, and maybe they were one of the great examples of the globalization of services, right? Being for many years at its inception a U.S. firm, to by the time we got there, it was clearly a multinational firm, and most recently it's a global firm where it's where does the service emanate? I think that kind of a uh, operating model is probably what more and more of the service providers are going to have to evolve to, where your quote country of origin is actually there isn't one, right? You are everywhere and providing that service from everywhere.
Mm-hmm. Right. Yeah. Interesting. So you talked a little bit a few minutes ago about sort of the U.S. being kind of historically kind of the hub or a geopolitical anchor or a financial safe haven, kind of the insurer of the global system, the rules-based order. Are you seeing? Do you think that that's really changing? Is that sort of the narrative out there, or do you think that's really changing in a meaningful way? Do you see that shifting as we look forward?
You have to answer that question by beginning with, how did it get there? How did the U.S. Kind of achieve that kind of status? And it was a combination of a lot of things, right? One was it's just its own heft in terms of trade, both as a importer and exporter. Second, the sheer size of the economy, and then as a consequence, the fact that the dollar became certainly the transaction currency of choice. And then in terms of reserves around the world, it became the currency of choice. And so then you add on to that the really the uh, technological and capability prowess that was built up by so many of these U.S. companies they were able to export that to other parts of the world, and then finally the view that the most stable, established, rules-based, rule of order-based country, all of that together created the status that the U.S. has. That's a whole lot to unwind quickly. So the question I think that everybody's asking is, well, that can't be true going forward, and therefore it won't be true going forward. And the point being, it may not be true going forward. It's hard to imagine a scenario, though, where that gets unwound and changed in a significant way quickly. Now, does it mean that it won't change? No, I believe that you will start to see, and you're already starting to see some changing patterns there in terms of well, you still have most transactions denominated in dollars, but you think about how the Chinese, for example, are how they're trying to purchase more and more in the renminbi, and why not? There's just a large player on the global economy, and there's lots of reasons why you'd like your credits and your liabilities to be in the same currency. So, will that change and unwind? Probably not. And this is a little bit the challenge, though, because having said that it won't happen soon, and there's a lot of structural reasons to believe that it won't happen soon, that doesn't mean it won't happen. I mean, the interesting thing about particularly investors is that we often overreact to what are kind of tactical things. So we overreact in the short term, assuming something large is going to happen, then it doesn't. And then that makes us assume that, well, since it didn't happen, it's not going to happen in the long term. And a great example of this is what happened, starting about a year ago in the run up to Liberation Day. And the view was the sky is falling. We're not going to see any kind of global trade any longer. We're all going to go into this, build and make and consume your own stuff and none of that. Well, that's obviously not happening. And we saw it in markets. Markets went, lots of volatility, lots of fall off in markets in the time after, early April. And then by, July, we recovered everything and it was like nothing had happened. So neither of those are true, is my view. That over the long term, it would be hard to believe if you believe that that there is this form of reglobalization, reshaping, rewiring of what's going on, that you won't see some associated rewiring of capital provision and the way capital flows around the world.
Yeah. No, your point about markets is so interesting because it's a little like things, nothing happens, nothing happens, nothing happens. Then all of a sudden everything happens. And so it's very rare that markets slowly adjust. It's usually sort of lurching from one to the other. And I think that's what concerns some people about the central role of the dollar is sort of where do you go, where would we, where would people go? And slowly over time, that makes sense. Do you think that there's one view that you'll have sort of regions or pods or whatever you want to call it, that people in a certain region will use a certain currency and invest with each other and so on. Do you see that happening? And a dollar pod and a renminbi pod and a euro pod or whatever it is, or is it not? Is it not that simple? Is it still much more complicated than that?
Well, if you believe that there is this reordering, and that the reordering, it's not that the U.S. and the U.S. dollar will go away, but the U.S. dollar will go from being the only game in town to a central game in town to a game in town. And so it'll still be significant. I mean, there's, again, barring some kind of unforeseen catastrophe, it's hard to believe that it won't be a significant game in town. But it's also hard to believe that it will be the only game in town because, again, you can't. It would make no sense to have that kind of reordering without, if you're, for example, the Eurozone, and you're seeing now much less reliance on the U.S., much more reliance on each other in that zone, that, why wouldn't you see actually more capital flows associated in the euro as opposed to the dollar?
Mm-hmm. Yeah, and your point about having your credits and debits in euro currency, that I mean, it's easy for us as sitting in a dollar-based economy to not worry about it so much. But if you're in one of the others, I think that becomes very, very, very real. Yeah. So another example of a economy that gets sort of is very global is Singapore. And Lawrence Wong, the Singaporean prime minister, recently described the current geopolitical situation as messy and unpredictable. And I often think of Singapore as a place that's sometimes on the leading edge of these, because obviously its location, its reliance on trade, and so on. So imagine you're in, whatever country it is, but how do you think about, with all of the volatility we've talked about, the outcomes being harder to forecast, as a long-term investor, or if you were, a company in one of those places, really, how do you distinguishing between what is a temporary disruption, what is noise, what is the, politician of the day sort of thing versus long-term change, real long-term change? I mean, Mark Carney said, it's a rupture a couple of weeks ago. So is this a rupture, or are we, how do you distinguish between overreacting to the noise and really seeing the change when it's coming?
I go back a little bit to what I said earlier. I think there is a danger of overreacting in the short term and underreacting in the long term.
Mhm.
Meaning that I don't think these changes will take place immediately. And because they won't, and markets will, seemingly shrug it off, and it'll be easy to say, well, maybe this is a non-issue. So, I mean, that's just another awkward definition of uncertainty, right? That we really don't know. We certainly don't know timing, and we don't know even to what level. What is this? What does the reorder actually look like when it all settles down, assuming it does settle down? So what that means is you've just got a lot more uncertainty. I mean, if you think about, again, I'll put it back to from the perspective of the investor. If you think about the post-crash, post-financial crisis of the late, 2008, 2009, it was pretty easy bet, bet on the U.S., and that worked for almost everybody that did it. If you have a feeling that there's some change that's happening, it will affect all the things that we've talked about. So how you invest in that kind of uncertainty actually really matters. Diversification will become much more important because of the uncertainty. How you think about purchasing insurance of different kinds, and I don't necessarily mean insurance as in the property casualty and life form of insurance, but how do I create some kind of insurance about here's what I believe, but this also may happen. And so how do I invest for this and protect for this? And it just makes the world a whole lot more complicated. I mean, we started this conversation around goods because it's the easiest way to think about it. Now I have multiple supply chains. Now I have multiple suppliers. It's a little bit more complex. I got to manage more. It's going to cost me more. Well, what does that mean then as an investor in terms of how I or my institution, how we deploy capital? So it'll be a little bit harder. You have to start to dig into it in terms of well, who will benefit? What are some of the risks, but also some of the opportunities around this? And again, simple example, but to the extent to which you're now seeing in most parts of the world, but certainly in Europe, a much more a view that Europe needs to become more self-reliant, for example, on defense. Well, that implies an investment in defense. And if you're concerned about suppliers, are you going to buy all those defense capabilities from the U.S.? Well, I mean, the U.S. has great defense capabilities, so you're probably going to buy some, but you're probably not going to buy it all, right? So European defense, right? It's a place to invest, develop the sector more, and that's a potential source of new return that we didn't have before. So it creates opportunities as much as it creates risks that need to be managed. But I think the most important thing that we all have to understand is anybody that says they know where this is going to shake out, I'd love to meet them, right? And if they truly do that, I'm going to give them our portfolios and say, you manage it for me. If we really don't know. So the investment, whether you're investing on behalf of your company or whether you're investing on behalf of others, from a financial investment return has become a lot more complicated.
Yeah, it's a lot more complicated. And I think to your point, where you sit is also makes it more complicated. So if you're a U.S. investor with U.S. liabilities, that would lead you to one outcome versus, for example, a large sovereign wealth fund somewhere else that may have different political considerations and different currency, perhaps that they're measuring in. So I think that when you start thinking of the interaction of all of those things, you can get to. As I think about portfolios over the last number of years, if you looked at a lot of portfolios around the world, they would kind of sort of look pretty similar, but now they're not because of all the issues that you're talking about. So I'm sure you see that, portfolio A and portfolio B might have had a few differences 10 years ago. Now maybe they look much more different than they once did.
Yep. And I think as an investor, we have to understand that many of these decisions and policy changes are being made not with an exclusive profit and loss kind of objective, right? There's it's all the things we've talked about in terms of protecting ourselves from a supply chain perspective, but also making explicit decisions, right? We don't want to be as reliant on the U.S. It's going to cost us more to not be as reliant on the U.S., but we're saying now we're going to go down that road as an investor. Well, what does that mean if I want to invest in a Canadian company that wants to be less reliant on the U.S.? What does that mean in terms of short-term and long-term return?
I heard a phrase a couple of weeks ago that I'd never heard before, was that somebody was looking for a U.S. free supply chain. And I had never heard anybody use the word U.S. free supply chain before, but it's exactly to your point. So if you don't have that crystal ball, you don't know exactly what's going to happen. As you said, if you find that person, send them your way. And you've talked a lot about how things nothing happens until they happen, or sort of it's very slow, it's shrugged off until it really does. But if you look sort of 5 to 10 years out, as long as the eye can see, whatever that is, what do you think that where markets and investors are most underestimating today? If you had to make your best guess, is it about how things are going to evolve? Is it dollar? Is it strength of economies? Is it flows? Is it what do you think is going to matter more than you hear people thinking about right now?
Yeah, so much of the attention has been paid, and even I and my language are falling into the same trap. Been around trade flows, how they're being interrupted, how they no longer are neatly ordered by what makes economic sense. Other considerations are going in there, and that's a very important factor right now. But it also happens to be the issue du jour. And your question is the right one for all of us to be asking ourselves, which is, what else is out there, particularly when you open the lens a little bit further and look out beyond the next 2-3 years. There's several for me. One is just debt levels. Sovereign debt levels are really high with lots of the pressure only seems upward towards more and not less. And you couple that with interest rates, which are no longer at zero, where sovereign debt almost didn't matter because it was no big deal to service that debt. So at what point do these debt levels become unsustainable? And you think about the things that we're talking about, again, very little of it is about being more efficient. So that suggests that this is going to cost more. And if that leads to more sovereign debt, that's one thing that I worry about. And we just don't really know what the limit is. Are we starting to see some limits when some of the activity we've seen in Japan and the JGB, constant kind of concern about the US, at what level does that matter? And it's hard to talk about debt in the abstract because debt is only too much if there's not growth to sustain it. I mean, it's like any other sovereign debt is not dissimilar to private debt, right? Debt by itself is neither good nor bad. It depends on what's your income, what you're incurring debt for. And to the extent to which we believe that all this is going to drive more growth, and that growth will take some kind of step function level up, but we don't know that yet. What we do know is that debt levels are going up and there's pressures on more. If you think about what Europe is facing in terms of potentially having to pay more for defense, for example, if you think about the United States, I mean, again, almost by definition, we're creating less efficient supply chains. How will that translate into debt levels? So that would be one. Secondly, there was a neat ordering that was out there before, kind of trade flow, open trade flow, was almost associated with this tremendous period of peace that we've had in the world. It's not been peaceful everywhere, but certainly we've actually gone through one of the most peaceful periods in modern times. Will that change as a result of all this when we no longer have the reliance or need to work with trading partner A? Do we now have some sense that we might go to war with trading partner A? And then last but not least, I really don't think that in many parts of the world that we're properly pricing climate adaptation. And climate's a four-letter word, but the realities are that the weather is changing. The cost of adapting to it is a tough one because it's really hard to get private investment in that. I always ask the question, what investor wants to lend money towards a seawall or, take an equity stake in a seawall? I mean, that stuff tends to fall on governments, which again is going to fuel this sovereign debt problem. On the positive side, I may sound like the world is falling. I'm not. I'm actually reasonably optimistic. If you think about emerging markets, which have been so out of favor, they've done pretty well. As a result of being out of favor, they've actually, as a group, you can pick out economies that don't fit within this, but as a group, they're much stronger than they've been in decades. They've had fairly sound fiscal policies, have learned to deal with a strong dollar, et cetera. So there's, in my mind, there's lots of investment opportunities in areas like emerging markets, which we really haven't talked about in well over a decade.
So we've gotten to almost 40 minutes and we haven't said the word AI. So, which really surprises me. So do you put that as do you think that is something that, as you've talked about these long-term trends, whether it's, sovereign debt or the potential for conflict or the, immigration and the challenges around that and the demographics or, adaptation, or on sort of the risk side, or emerging markets, I heard you say that's kind of that's a positive side. Where do you put AI, or is it just interwoven in all of these issues now, and it's just part of the fabric of analyzing any of them?
Oh, I mean, AI, at some level, you could say AI is another step function technology disruption that we've seen before. What's different about it is the speed with which it's happening, right? So even relatively recently, the advent and adoption of the internet. I mean, we saw what happened. There was this boom in investment in the mid to late 90s. The internet was going to be everywhere and consume everything, and it didn't. And we had a bit of a market crash. All that fiber had been laid, all that stuff, all that infrastructure had been laid, and guess what? It wasn't being used, and that led to other things. And then 5 years later, it actually did happen. So AI is happening much faster than all that. And at some level, will actually be a mitigant to some of this. It could be a mitigant to, for example, some of the immigration concerns that I raised. I do think that in many respects, I mean, the real question now, and we're feeling it literally as we're here on February 6th, there's these little bit of tremors in the market, and some of it is around, well, is there some overbuilding here? Some of it is around, what's going to happen to incumbents. Listen, it's a ubiquitous technology. Everybody has it in their pocket now, or could have it in their pocket if they want to use it. It really is how it's being deployed and how rapidly it's being deployed. And I don't think we at State Street are much different than anybody else. I mean, we are well into this journey in terms of thinking about how do we do better things for our clients, better things for our shareholders. It will change the nature of work. I don't think it's actually going to result that, we'll go from employing 48,000 people to 8,000 people. Will we be more efficient? Most certainly. I mean, we're already seeing that. Will the nature of work change and the nature of jobs? Yes, that's happening now. Will new jobs be created? Absolutely. So this whole point, for example, on entry-level workers, I really don't, I don't get what's going on here where people are saying, well, there will be no jobs for people coming out of university. We can't wait to get the new university hires in because this generation that's coming in now is actually AI native. And who wouldn't want to have people that are not adapting to this, but were basically kind of gone through school and are thinking about this? The kinds of skills that people will need, they are going to be different. But what we absolutely need are problem solvers. Because if you think about the technology and what's enabled by this, it's limited only by, in some ways, our imagination in terms of how we use it. There's real engineering that needs to take place. If you're going to succeed here, whether you're an incumbent or a disruptor, it's not just about having the technology in your pocket, but it's about how you engineer it into an existing business process and system or create a new one, right? That's going to require people to think about that. And will AI accelerate all that? For sure. But to me, I don't think it necessarily changes any of the macro monetary capital kinds of things that we've talked about. But it may be a tool and likely will be a tool to manage it, whether it's managing those risks or creating new opportunities that arise out of it.
Well, I think that's probably a good place for us to stop, which is there are a bunch of, long-term risks out there, long-term things to consider, but there's a lot of exciting stuff going on too as we think about deploying capital over time and, to have that long horizon of, a long career as well as a student of history, and then try to be able to apply it, not with a crystal ball, but sort of a little bit of a bet with a hedge going forward, I think is very, very good advice for investors and also, people who are planning their careers or anything else as they look forward. So thank you for your time, your insights, for your ability to really think over that long-term time frame. And we really appreciate your insights. Thank you, Ron.
Thanks, Sarah. I enjoyed it.